What if I told you there's a dividend ETF you've probably never heard of that's not just beating SCHD, it's actually tripling its returns since inception? This fund doesn't just match the S&P 500, it's outperformed it by 10% and even kept pace with the NASDAQ 100, all while balancing income and growth in a way most funds struggle to achieve. And here's the kicker. When the NASDAQ 100 dropped 20% during the 2022 bear market, this ETF lost less than 3%, showing an impressive level of defense. What makes it stand out isn't just its results. It's a unique strategy that combines momentum with a surprisingly low turnover rate. That's not something you see every day in the world of dividend ETFs. So if you've always assumed the best dividend fund is the most popular one, it might be time to look a little deeper. When it comes to dividend investing, most people gravitate towards the big names, the funds everyone talks about in online forums and financial media. But there's a core issue with the most popular dividend ETF that goes unnoticed. They force investors into a set of compromises that can limit long-term results. This is what's known as the false trichotomy in dividend investing. Instead of finding a fund that truly balances income, growth, and stability, investors are usually left picking from three types of ETF, each with its own shortcomings. Let's break down what that actually looks like. First, there are the passive qualified dividend ETFs, like SCHD. These funds are popular for a reason. They're straightforward, low cost, and offer a sense of security. Their yields tend to land in the 2% to 3% range, which is decent for steady income. But here's the problem. During market rallies, these funds often lag behind. Their focus on established dividend payers means they can miss out on big gains that come with more aggressive growth stocks. So while you get consistency, you might also be leaving significant returns on the table when the market is strong. On the other hand, you have high income covered call ETFs like JEPI or JEPQ. These funds draw attention with yields that can reach 10% to 12%. For investors looking for immediate cash flow, that's hard to ignore. The catch is that these ETFs use option strategies that cap their upside. They're great for income today, but their growth potential is extremely limited. If you're investing for the long haul, say for retirement, this trade-off can be a real concern. Over time, the lack of capital appreciation can leave your portfolio lagging behind inflation or missing out on wealth-building opportunities. Active ETFs promise a mix of growth and income, but high turnover often disrupts dividend compounding and drives costs up. The idea behind these funds is appealing. Professional managers selecting stocks and adjusting sector exposure to capture both growth and income. In practice, though, frequent buying and selling means the fund's holdings are constantly changing. This not only increases expenses, but also interrupts the steady accumulation of dividends, making it hard to achieve consistent, reliable growth over time. For many investors, this inconsistency is just as frustrating as the limitations of passive or high-yield funds. The result is a landscape where investors feel boxed in. You can have safety with modest yields, high income with little growth, or professional management with unpredictable results, but rarely all three together. The industry has set up these choices as if they're the only options, but that leaves a lot of investors unsatisfied, especially those who want their portfolio to deliver both meaningful income and the potential for real appreciation. This dilemma isn't just theoretical. It shows up in the numbers and the real-world performance of these funds. SCHD's 2% to 3% yield is dependable, but it hasn't kept pace with the market's strongest runs. Covered call ETFs offer headline-grabbing 10% to 12% yields, but their growth is capped by design. And while active funds promise more, their high turnover can quickly erode to benefits of compounding dividends. So, what if there was an ETF that didn't force you to settle? What if you could have a fund that offers competitive yields, strong growth, and real stability all in one package? There's a fund out there quietly breaking away from these limitations, and its results suggest it could be changing the game for dividend investors. What if there was a dividend ETF that didn't just outperform SCHD, but also rivaled some of the biggest growth behemoths in the market, like the NASDAQ 100? SCHD, the Capital Group Dividend Value ETF, stands out by reshaping what investors expect from a dividend ETF. Rather than forcing a choice between steady income and real growth, SCHD brings both to the table, backed by performance that's hard to ignore. Since its launch in February 2022, SCHD has not only tripled SCHD's returns and outperformed the S&P 500 by 10%, but it has also matched the NASDAQ 100, a feat that's especially rare for a fund focused on dividends. This isn't about luck or a short-term trend. It's about a deliberate approach that combines the best elements of growth and income strategies. One of the most common concerns with actively managed funds is high turnover, which can eat into returns and disrupt the compounding power of dividends. SCHD challenges that perception. Its turnover rate is about 30%, nearly identical to SCHD's 28%. This low turnover discipline means SCHD isn't constantly churning its portfolio, but instead holds onto high-quality, well-researched positions. The result is a strategy that feels almost passive in its steadiness, but with the added benefit of active oversight to adapt when opportunities arise. The major reason for SCHD's strong performance lies in its sector allocation. While many dividend ETFs lean heavily into industrials, SCHD splits its assets almost evenly across technology, industrials, and healthcare. This balanced allocation gives the fund exposure to powerful growth trends like artificial intelligence and digital transformation, while anchoring stability in healthcare. The ability to capture upside from tech-driven rallies without sacrificing the defensive qualities of healthcare and industrials sets SCHD apart from more narrowly focused peers. This sector mix isn't just about chasing the latest trend. During the recent surge in AI and tech innovation, SCHD was able to benefit from rising valuations in technology giants, while still holding companies that provide reliable dividend income. At the same time, its meaningful allocation to healthcare acts as a buffer during market downturns, since healthcare stocks often hold up better when the economy slows. By not putting all its eggs in one sector basket, SCHD builds a portfolio that can adapt to different market cycles, offering both resilience and upside. Another factor that makes SCHD unique is its multi-manager structure. Instead of relying on a single portfolio manager's outlook, SCHD is run by 5 managers, each with their own investment style and background. This collaborative approach brings together a range of perspectives, helping the fund navigate shifting market conditions. It's a bit like having a team of experts, each contributing their strengths to create a more robust and flexible portfolio. This structure can help avoid the pitfalls of groupthink or overconfidence that sometimes affect single manager funds. SCHD's investment process also focuses on fundamental quality. The fund targets companies that not only pay dividends, but have a proven track record of increasing them. To qualify, a company must have raised its dividends at least 3 times in the past 5 years and keep its payout ratio below 60%. This attention to quality helps SCHD avoid chasing unsustainable yields and instead zeroes in on businesses with strong balance sheets and reliable cash flows. It's a disciplined approach designed to provide both steady income and room for future growth. Momentum is another key part of SCHD's strategy. Rather than simply following an index or trading constantly, SCHD looks for stocks that are already showing strong performance and have the potential to keep that momentum going. By focusing on companies with both upward price trends and solid dividend histories, the fund aims to ride market waves that are already forming, rather than guessing where the next one might appear. This approach, combined with low turnover, helps SCHD capture growth without sacrificing the consistency that dividend investors value. All these elements, sector diversification, low turnover, and multi-manager teams, momentum-driven stock selection, and a focus on dividend quality, work together to explain why SCHD stands out in a crowded field. The fund's results so far show that it's possible to achieve both meaningful growth and reliable income without having to settle for trade-offs that limit so many other dividend ETFs. Of course, strong returns and smart structure raise an important question. How exactly does SCHD manage to balance growth and income so effectively? Understanding the mechanics behind its approach is the next step in seeing whether this fund truly offers a new model for dividend investing. At the core of SCHD's outperformance is a strategy that combines two powerful but rarely paired factors: momentum and low turnover. This combination is what sets SCHD apart from most dividend ETFs and is a major reason for its strong results in both up and down markets. SCHD rides stocks already showing strength, then holds them long enough to capture rising dividends. Momentum investing is about finding companies that are already gaining traction in the market, often in sectors like technology and healthcare, and positioning the portfolio to benefit as those trends continue. The key difference with SCHD is that while it leverages momentum, it doesn't fall into the trap of constant trading. With turnover at around 30%, nearly matching SCHD's 28%, SCHD sidesteps high trading costs and preserves dividend compounding. Unlike some active ETFs with turnover rates above 350%, which can erode gains and make it difficult to maintain consistent income. Quality is the other pillar of SCHD's approach. Rather than simply chasing yield, the fund sets a high bar for the companies it holds. 90% of assets are in investment-grade companies that have raised dividends at least 3 of the last 5 years to keep payout ratios under 60%. These strict requirements ensure that SCHD's holdings are financially sound, with enough earnings retained to fuel future growth and cushion against economic shocks. The minimum market capitalization for inclusion is $5 billion, and every company must offer a dividend yield of at least 1%. This focus on quality and sustainability is a big part of why SCHD weathered the 2022 bear market with a minimum decline. While many funds struggled, its portfolio remained resilient. The fund's low turnover discipline is especially notable given its active management. Most active funds that try to capture momentum end up trading frequently, which disrupts dividend compounding and drives up costs. SCHD's managers avoid this by holding onto high-quality stocks through market cycles, only making changes when there's a clear opportunity or risk. This approach allows the fund to benefit from both stable dividend payments and the long-term growth potential of its best-performing holdings. SCHD's structure also plays a key role in its success. Instead of relying on a single manager, the fund is run by a team of 5, each bringing their own perspective and expertise. This multi-manager system encourages a diversity of ideas and helps spread risk across different investment styles. It also means the portfolio can adapt more quickly to changing market conditions without becoming overly concentrated in any one area. This collaborative approach has contributed to the fund's ability to balance growth with stability and maintain a disciplined investment process. Sector diversification is another important factor. Rather than overcommitting to a single hot sector, SCHD splits its assets almost evenly among technology, industrials, and healthcare. This balance allows the fund to capture upside from tech-driven rallies, while healthcare and industrials provide a buffer during market downturns. By not putting all its eggs in one basket, SCHD can participate in new growth trends without exposing itself to unnecessary risk. The result of these combined factors is a portfolio that consistently delivers both income and appreciation. SCHD's momentum strategy means it doesn't miss out on market rallies, while its low turnover and quality focuses ensures that dividend growth is steady and reliable. For investors, this translates into a fund that can provide meaningful cash flow today and the potential for capital appreciation over time. It's rare to find an ETF that manages to capture both sides of the dividend investing equation so effectively. As more investors search for ways to bridge the gap between growth and income, SCHD's approach is starting to attract serious attention. The question many now are asking is whether this fund could become a core holding for those seeking the best of both worlds. Why does SCHD stand out as a potential blueprint for the future of dividend investing? Its rise has been fast and, considering the market environment, impressive. Launching just before the 2022 bear market, SCHD faced a real-world stress test almost immediately. While the Nasdaq tumbled 20%, SCHD's downdraw was only 2.89%. This wasn't just about avoiding losses, it was about providing resilience when it mattered most. That kind of defensive performance, especially for a fund so new, caught the attention of investors and analysts alike. SCHD's rapid asset growth tells a similar story. In less than 2 years, it has attracted nearly $16 billion in assets under management. That's not just a headline. It's a signal that investors see something different here. Accumulating that level of capital, especially during a period when many funds struggled to maintain inflows, points to a high degree of trust in both the fund's approach and its ability to deliver. People aren't just chasing recent performance. They're recognizing the potential for a new model of dividend investing. It's natural to question whether a young fund can keep this up, or if it's just benefiting from a short-term market quirk. But SCHD's structure and process suggests a repeatable edge. The fund uses a multi-manager approach, drawing on the expertise of 5 portfolio managers with diverse backgrounds. This isn't just a marketing point. Multiple managers means more perspectives, better risk management, and the ability to adapt to changing market dynamics. That diversity of thought and experience helps SCHD avoid the pitfalls that can come from relying on a single manager's outlook. And it's a key reason the fund has navigated both up and down markets so effectively. Looking at how SCHD allocates its portfolio, you'll notice it doesn't stick to the usual playbook. Traditional dividend ETFs often concentrate in financials or industrials, which can mean missing out on the fastest growing sectors. SCHD, on the other hand, splits its assets almost evenly between technology and industrials, with healthcare making up a strong third allocation. This balance lets the fund benefit from both the steady income of established sectors and the explosive growth of emerging trends like artificial intelligence and digital transformation. By not overcommitting to a single sector, SCHD creates a portfolio that can adapt and thrive as the economy shifts. The fund's approach to income is just as compelling. In its first year, SCHD boosted its yield by more than 50%, dwarfing SCHD's 16% dividend growth over the same period. This isn't just a one-off spike. It's evidence of a strategy that can deliver both rising payouts and capital appreciation. For investors frustrated by the old trade-off between growth and income, this kind of performance is a game changer. It shows that you don't have to settle for modest yields or give up growth potential to get steady income. SCHD's adaptability is another reason it stands out. Its sector mix, momentum-driven stock selection, and focus on quality companies allow it to shift gears as market change. When growth stocks are in favor, SCHD captures the upside. When markets get rough, its healthcare and industrial holdings provide stability. This flexibility has allowed the fund to perform well in both rising and falling markets, which is rare for any ETF, let alone one so focused on dividends. The broader takeaway is that SCHD is meeting a need many investors have felt for years, a dividend ETF that doesn't force you to choose between income and appreciation. Its rapid growth, innovative structure, and early results suggest it's more than just a short-term outlier. SCHD is showing that the old rules of dividend investing are ready for an update. As more investors look for funds that can keep up with changing markets without sacrificing the core benefits of dividend investing, SCHD's approach is likely to attract even more attention. The real test will be whether it can maintain this balance as it grows, but its first 2 years offer strong reasons for optimism. If you're looking for a fund that can deliver both steady income and real growth, SCHD's strategy and results so far make a strong case. It's challenging the idea that investors have to make tough trade-offs, and it's prompting a lot of people to rethink what's possible in dividend investing. This shift is opening the door to a new standard, one where growth and income don't have to be mutually exclusive. SCHD stands out by offering investors a real solution to the long-standing challenge of finding both growth and rising income in one fund. It's not just another ETF. It's a step forward in how dividend investing can work, backed by impressive results and a thoughtful approach to portfolio construction. If you haven't looked closely at SCHD yet, now is a great time to see how it could fit with your investment goals. The smart money is already taking notice, and opportunities like this are rare. If you found this insight useful, hit subscribe and the thumbs up to stay on top of game-changing ETFs. Will SCHD remain this powerful, or will the crowd catch on? Only time will tell. But you can decide today.